Let's take a look at one important decision that a business might make. Since we've been talking about balance sheets and statements of changes in equity, it seems appropriate to look at a couple of decisions that you might be made with regard especially to dividends. If you'll recall, corporations are controlled, or the major decisions are made by a group called the Board of Directors, who are elected by the shareholders in an annual meeting. So the shareholders are the vote on who the Board of Directors is, but the Board of Directors makes the decision as to how much could pay as dividends. So if we look at the definition of retained earnings, it is how much the company has earned but has not paid out to the shareholders. That's money that you could argue the shareholders are entitled to. So there must be a good reason that the Board of Directors does not send that money to the shareholders. And remember, shareholders have invested their money to get a return back on their money. And one of the ways they get that return is in the form of dividends. So dividends and deciding how much is an important decision. So we're going to look at TJX companies. That's the parent company for TJ Maxx. You may have be familiar with those retail outlets. They announced at the end of February that they were going to pay a higher dividend than the year before, than they did the previous year. So let's look at their balance sheet and see what might have led the Board of Directors to make that determination and that announcement. First of all, there needs to be stockholders' equity. Now, this is a preliminary balance sheet. See, it's unaudited. This is in millions, and you can see the dates that we're looking at. This is two balance sheets. Remember, balance sheet is a snapshot in time. So on February 2nd, this is the assets, liabilities, and equity. February 1st, 1 year later, this is the assets, liabilities, and equity. Notice that shareholder equity went up. So that probably indicates that our net income was greater than any amount we paid out in dividends in between those two dates. That's why shareholders' equity increased. And that would be an indication that we have retained earnings increasing and can pay that out as dividends, because that is what retained earnings is what we can pay out. But the other thing is we pay dividends in cash, so we need to also check to see if we have the cash necessary to pay dividends, or sufficient cash. And we notice that cash also went up. So despite paying dividends last year, our cash still increased. And so we're looking at having about, at TJ Maxx or TJX, $3.2 billion in cash. That seems to be a substantial amount of cash, and that would indicate that we could afford to pay the dividends out without risking not being able to make other obligations. And if you look at their income statement, for last year, since we already talked about that a little bit, here's the income statement. You'll see that net income from this year that just ended is higher than it was the year before. That indicates that we are being successful profit-wise in generating net income, with an also indication that we can make more net income and therefore should share what we have with what we have earned with the shareholders. Then we look at the cash flow to make sure that and to see where the cash comes from, and we see that our cash from operating activities went up, well, about the same as last year, but still a significant amount, and far more than we needed to buy new property and equipment. So even though we invested a significant amount, we did not spend near as much as we generated from our business. And we used that cash in the past year to pay dividends and to buy back our stock. We don't have a lot of debt to pay off, and so we can utilize the cash and increase this dividend and still not spend all of the money that we have generated from our business. That's usually what we want to look at when we're talking about either paying a dividend or increasing the amount of the dividends as we look to the health of our company. So that gives you an idea of what how that decision might get made and what we use that information to determine for the company going forward. The other thing to remember, once the shareholders have received a dividend, it's very hard to they're not going to react positively to you reducing it or taking it away. So the idea is, if you're going to start paying a dividend, you need to be able to continue it. And if you're going to increase it, you need to also be able to continue paying at the higher level, because going back the other way is usually not such a good strategy. So that's why we look at the past and what we have as far as cash, but also they would try to look towards the future to see if they would be able to continue that kind of profit and the kind of cash generation that we need. So there's two pieces. You need to be profitable, make money on your operations, and you need, that was indicated by net income, and you also need to be able to have the cash to pay it indicated on the cash flow statement. Those are not, those go together, but they're not the same thing.